Hedge Nordic, your single access point to the Nordic hedge fund industry. In this virtual roundtable discussion on managed futures, we welcomed experts from Transtrend, Quantica, Systematica and Volt Capital. Topics discussed include the return and dispersion drivers during the COVID crisis, risk management, alternative markets, the next generation of CTAs and more. So let's dive in.
2020, of course, has been a remarkable year in many aspects. I guess many of us also can't wait to get this one behind us. The fallouts from 2020, not just the COVID crisis, the health crisis, the financial crisis, the economic crisis with job losses, companies going, we will feel for a long, long time. But let's maybe go back to the early days, to February, March, April, when also the financial markets were impacted very heavily. And maybe Nikolai, you can start telling by us how you experienced the liquidity and volatility of those times and how your systems performed.
If I remember March this year, it probably felt like a month that lasted for 10 years in terms of what happened. That certainly also was the case for the team here. It was an intense period. I think basically what made this crisis a bit unique was the unprecedented pace of sell-off of the equity markets. We went into a record number of days into a bear market. And for a medium to long-term trend following approach like the one from Quantica, it's obviously a challenge to deleverage or reduce your exposure to equity as fast as you can. So it took us roughly 4 weeks to scale down. Obviously, the initial market environment did not favor us initially, as we were coming out of a very strong equity upward momentum period. And so we were long, I think, around 120% net long exposure going into February, and we had to scale this down. So this was mainly what happened for us. And I think there was a very wide dispersion among CTA managers, trend followers in March. And for us, the number one factor that explains that dispersion is simply the trend speed. So we figured out that just by changing, taking a simple generic trend following model and changing the moving average by 10 days had an impact of up to 20%, depending on what type of model you're looking at, which tells you a lot about what was going on. But ultimately, it was all about how much equity exposure did you have running into March, and with what type of investment horizon you are implementing your models. So for us, it was a rough ride. But it was short-lived enough, this crisis, so that we could capture a lot of the upsides going out of March because we didn't turn short equity, which was probably quite a differentiating aspect compared to some peers. But it's a consequence of how the model works.
For us, I think what is worthwhile noting is the big dispersion we have seen in the CTA space. I think Nikolai is right that certainly aspects of this can be explained by the trend speeds themselves. So the faster trends, they at least the trend type systems we're looking at, they work much better in March compared to say medium and the slow trends. Actually they perform quite poorly. But even the medium and slow trends, they did not do that poorly, in fact, at least in our versions. But I think there's a second thing which has happened in the industry, which is people have allocated more to non-trend strategies. And if you think about I would say the two trends which have appeared in the CTA industry since 2009 is, I would say there is some evidence that people have slowed down their systems. It's not quite clear that every manager has done that, surely not, but overall, there is some evidence for that. And I think the second thing is that there has been a bit more style drift. So people have introduced more allocations to diversifying macro strategies which are non-trend following in nature, and both this slowing down plus allocating more to non-trend type strategies, that makes things less defensive. And the huge dispersion which we have seen in March, where in the usage space you have seen numbers plus 7%, you have seen the same on the negative side. I would say that's mainly explained by slowing down a bit, and also non-trend following type strategies. What we observed in the alternative market space was the fall in liquidity. So I would say generally liquidity has been falling across all markets. Slippages have increased across all markets, but our investors, of course, they were very curious whether at the size we're running now in the alternative market space, whether that will pose a problem. I know overall, in summary, I'm very pleased that things went really well, but it is thanks to kind of the very broad counterparty setup we have. We did experience some problems in markets, I would say, especially like in the emerging market IRSs, in some of the EMFX non-deliverables. But overall, things went very well for us in March.
I think the dispersion is caused by more than just speed and markets traded. I think we had a long period in which it was almost become a kind of academic idea that trend following was just one kind of thing in which speed and the markets traders were the only parameters that really made a difference. The history of trend following CTAs is much more dispersed CTAs. It was the case already also in 2008 and in 2002. So that has nothing to do with changes happening lately. I think there's a change going on back to more dispersion between different CTAs, which is only healthy. If you just look at the basic principles of CTAs, you can distinguish two, in very rough terms, two types. One is the idea that it's stop and reverse. So the people telling this story have a very simplistic story of telling you cannot lose trend following because when markets reverse, we will reverse positions as well. And the other side is the diversification-based approach that essentially says you cannot lose in trend following because when you lose in one market, you will profit in another market. The one typical thing about this crisis is that it was not a financial crisis. It was not a crisis from within the financial markets. It was a crisis from health among people. And no one of us is, of course, invested in viruses that make a big trend. So it's something from the outside. The stop and reverse type of approach, especially when it's somewhat faster, indeed did better in that period than the typical diversified approach because of this element that is an outside event. So that is, I think, also an important factor that explains the difference between different CTAs.
We are both systematic traders. And being systematic means that we kind of want to, or we need the world to repeat in some way. And clearly, the COVID-19 crisis was a new thing, hadn't happened before. So I think for investors to expect that to in itself provide opportunities is sort of the wrong type of thinking. It's a crisis, but it's a new crisis. And 2008. Even if it was unprecedented, perhaps in magnitude, had rhymes with, for instance, the crisis in Sweden in the 90s. Then if we look at this year overall, we had another big surprise, which is that monetary stimulus came much, much faster than anyone expected, right? So the fact that COVID-19 turned into a financial crisis meant that suddenly there was a political will to actually do something, which is completely opposite to 2008, where the political will, especially in the US, didn't exist. We had the politicians in the US coming together remarkably fast. So we had both the crisis in March and the recovery, that we are in the middle of that recovery right now. So both of these things are tricky things for systematic traders to handle. So, from our perspective, what were the key elements to actually having positive returns this year? Well, I think the first part was we are fundamental. So we are fundamental 100%, and to some extent, our signals will try to predict what will happen. We are bottom up, but we were focused in several of our sectors. We saw an economic slowdown, we saw slower growth, we had the trade tensions between the US and China, and these would be negative for the world economy. At the same time, we were actually long stocks, but I'll get to that in a second. But being fundamental was actually an important edge, both in the first quarter and the third quarter. But the other thing here is when it comes to predictability, being diversified made a big difference. Because while equity markets were really erratic, I've been along, now that we're talking about history here, right? I've been around long enough to remember 1987. And when I saw what was happening in March, I was thinking, well, this is 1987 all over again. But that type of volatility is very hard to handle. And we also saw how the medical news just translated straight into equity markets, and that happened just a week and a half ago now again on the virus news. So that's very hard to handle. However, on the flip side, a lot of markets were very much more kind of much better behaved, and especially commodities. But the third thing, super important this year, and I think this is sort of where I'm seeing, you know, a key differentiator between managers, is that this was a year of risk management. You know, having modest risk on, having modest leverage, having the ability to trade out of positions, you know, really made a difference.
The one thing that didn't rhyme or repeat with this crisis is, of course, that we found ourselves working from home. That's the first. Harold, how was that for you and Transtrend? Was that a challenging situation, or did that work quite well? Or
suppose we would still have open outcry exchanges, people gathering on the floor like they used to do 10, 15 years ago, then the whole financial sector would have had much more problems, because trading on the floor would not have been possible. The few floors that were still there have been closed during that period. So the technology advantage that have been made in the past 2 decades helped financial markets being able to trade through this period. That would really not have been possible 20 years ago. In a somewhat more philosophical view, one could say that pure technically seen, we do not need to be together anymore. Technically, we get through a period like this without any problem. The only thing that people need to be at a place is to install some new hardware or something, but the rest of anything else can be done from home, and it's all right. But there is also the human aspect. And the human aspect is in the elements like crying together, laughing together, having bright ideas together, creativity, all those more longer term elements. And that is something that is incomparable from home versus being together in an office.
We of course have to do several preparations, especially like on the trading side. We have quite a big trading desk. We have 10 traders, and we equip them like with extra screens at home, etc. To make sure that their kind of work from home type trading desk kind of looks pretty much the same like the one in the office. If you work on an existing project, or if you just kind of do your business as usual type job, but when it comes to innovation, when it comes to discussing new ideas, starting a new project, coordinating kind of like the first steps, that just feels much harder, if you do it like via the usual video conferencing tools or like, chats, etc. So we did make an effort, to bring people from time to time from the research teams, etc., into the office to facilitate that type of collaboration and, kickstart things.
I just don't believe that you can do that from home office. Human interaction is important. We operate in a very complex industry. I'm not just talking about research. I'm talking about the interaction between the different units, be it trading, technology, research, and business development. And it's just a pain to do that like 7 days a week, or like whenever you are at home and going from Zoom meeting to Zoom meeting. It's just not possible. I think it's extremely inefficient. And I think I hope we will find the right equilibrium there. In terms of the relationship with the investors, I think that's also worth mentioning. Our experience has been that after the first week of March or the last week of February, everything freezed up. So all the meetings got canceled, Outlook got empty, and for 2 months, nothing happened. Like everyone was just reassessing the situation. We came to a complete freeze. And I think the good news, at least from our experience, is that over the last couple of months, there's been increased activity. We have moved to virtual, and it feels kind of normal. So due diligences that couldn't take place virtually before now can take place virtually. And I think this is a good dynamic because we travel less. And I don't know for you, but at least I'm appreciating that. And I think a lot of these meetings, people realize that they can be done virtually. But again, it's a relationship business, it's a people's business. And ultimately, I think this situation where we're 100% virtual is not sustainable because we need to interact with people.
There wouldn't have been so many billion people in the world if we would all have been isolated animals. All the progress as mankind we made was by working together and making ideas together, and that's what innovation is all about. Whether it's creating a fire or starting a fight or flying away to a higher area, it all has to do with telling to each other and working together, and then people can be really innovative, and that's not happening in an isolated situation.
for quite a few of us, this has opened our eyes for how enormously inefficient we were before. You know, scheduling a due diligence meeting 4 weeks out and traveling to a faraway place and getting on a plane and saying that, you know, a physical meeting had to happen before the next step in an investment process. You know, that's not efficient. We've had at least 2 cases where we had investments happening without any physical meeting at all. And I think that's, you know, in a lot of ways more efficient.
Now, I agree. Some of the changes, like for instance, less traveling, will continue, and will be a lot of that will continue to be like this for a longer time. But that was a trend that was already going on. In let's say 10 years ago, investors tended to travel much more and to visit investment managers much more than a few years ago already. So even without Corona, so that was a trend that was already going on. In the more creative and innovating processes, that's where people have to stick together and cry together and laugh together.
Does the CTA space possibly have a competitive advantage towards other strategies? Meaning you don't have to go and investigate companies or investigate if the airport is really functioning if you're a private equity investor. Everything is very numbers based. You've always been very reliant on technology.
But I think that actually we do have an edge over others. I think one of the things that, you know, we've done in our office, for instance, is we've said we want to be 100% automated. The systems turn themselves on in the morning and close themselves down in the evening. Everything should be automated from start to finish, and we only handle exceptions on a daily basis. Now, those things are trickier to get to in what should I call it? Value or investment processes where people have to have human inputs, right? If you're trading long short equity or something like that. But you know, we are, you know, statistically driven. I would, if I put it one way, and that allows us to get to this high degree of automation. For those of us trading only futures, you know, the liquidity also makes things easier because we have less concerns about, you know, the exact you know, execution points. We know that we have tools that will allow us a consistent execution, if I put it that way.
Liquidity is one example of the huge advantage that CTAs offer, especially on the liquid product side. I mean, we have seen an unprecedented crisis in March in terms of liquidity, as Matthias mentioned also in the beginning. You had widening spreads. Liquidity that was vanishing, but we did some analysis, and what is actually quite striking is that despite those extraordinary circumstances, liquidity was there. At least I'm talking here for the liquid markets. We are not invested in more liquid futures, so I cannot comment on that. But when you compare the liquidity metrics that Matthias mentioned in the beginning to the amount of risk that you could trade, actually the cost of trading 1 unit of risk improved even in March. So it became, if you normalize it for risk, your trading costs actually decreased for most instruments during that period of time. And I think this is worth mentioning because people just look at it. Yes, I mean, the available trade size, the available bid-ask size decreased and so on. But if you put that in relation to the risk, it didn't deteriorate. And it just proved that strategies like CTAs go through March like a non-event, I would say.
Futures markets by themselves have been created and have become successful, especially for the exchange of risk. And that's typical something that has to be done and will happen in a situation like we've seen in March, April. So as such, futures markets did what they are made for.
Yeah.
And it's good that it worked, but it would have been very disappointing if it didn't.
Exactly. Yeah.
I think Nicola, you have a good point there on this price of risk. But you know, we were surprised ourselves when we looked at slippage numbers coming out of first quarter. That actually it was, you know, even not risk adjusting was pretty good. So liquidity was there, it was active, and at least on our side we had lower transaction costs than last year.
I think it's a very good point. You know, I can probably add some of the experience we had on the more alternative markets. So now often people think, you know, alternative markets, that they're not very liquid. I would not say they're not liquid. Some of them are surely less liquid, but like, you know, overall there is this quite decent sizes which are traded in those alternative markets. So no, we clearly saw the slippage increasing, mainly because the spreads widened, but liquidity was actually there. There were only a few instruments. We trade overall, around 270 markets in that space. And we closed around 4 markets just to be kind of really cautious, to prevent any kind of potential market failure. It's some of the less liquid emerging market IRSs, but in terms of the risk they actually take of the overall offering, it's a non-event. And even that actually would not have been necessary. But we clearly saw the slippage, slippage to advise increase. Other metrics of slippage, as Nicolas mentioned, for example, adjusted for per unit of vol, etc. They looked completely normal. We did do a lot of trading though in March, and that's normal. When a CTA actually de-risks and takes off the exposure, you will see quite large increase in trading volume. So if we compare our trading volumes in March compared to say the average of last year, it was around 3 times higher. But that is normal because you're coming from a position where you have substantial risk on. Then the risk increases generally, and what you do generally is you cut your overall positioning on the notional terms.
One of the things I would like to discuss is risk management and how crucial risk management was in this period. Again, looking back at February, March, April, to get through the period, and if you had any substantial learnings or changes within your maybe philosophical approach to risk management.
It was very insightful, and what was insightful is again the pace, the spike in volatility was unprecedented. So I think we reached volatility levels that were even higher than during the great financial crisis. At least from the perspective of our models, the way they behave, we ended up in certain weeks in a state that was basically not captured by the models. So that triggered some reviews from our side and basically touching on the risk management. So certainly the need to be even more reactive. And I agree with Patrick when he mentioned that it's the year of risk management. I couldn't agree more, because risk management has been much more important than the trend following part this year from our perspective. And if there's one learning to take away from March, it's certainly to be even more reactive on the risk management side. That's one aspect. And then also on the implementation layer, there's always a learning to gain.
I think that this risk management plays also a role in what happened after March. Let's say what we and others have done often in the CTA industry is looking at crisis periods and define them as peak to bottom in the S&P. Well, to define this crisis as the period from peak to bottom in S&P, then the crisis would have been over on the 23rd of March. We all know how many people died after the 23rd of March and how many people lost their jobs and so on. So the crisis really wasn't over. So to use that metric is already wrong. But it's also important because in itself, this is nothing new. Also in 2008 and 2002, what happens after that is very important as well. Not only because Corona still impacts markets, and Patrick just named one incident earlier this month when the vaccine was there. And so then in that situation, the greatly Corona insensitive portfolio would have got a beating there. But it also has a big impact on the months afterwards, because these high moves and these huge moves in March had an impact on, or could have an impact on, estimates of correlations and estimates of volatility, which is an input to the trading you do after March. And if that would lead to an overestimation of volatility and an overestimation of correlation, then it would lead to smaller positions than you really wanted to have and an underperformance.
This was actually a really good event where we could look at the markets and we could feel, what is the real risk we're taking now? And is, for instance, our valued risk measure or our correlation measure reflecting what we believe is happening? Because, all these measures, say valued risk or say correlation or say volatility, depends on the sampling of markets. And, once a market has whatever dropped 20%, is this measure that I'm using, is it still relevant? We definitely looked at our measures and we saw, what certain things that we felt were perhaps over or underreacting to things that we would be tweaking those. And that's part of managing a systematic trading program. You reinterpret, or sort of you have a view of what you want to achieve using your systematic process. When some event like this happens, like we saw in March, or quick reversals, you go back and see if your estimators, your signals, your portfolio construction, if it all makes sense. When you get the opportunity of analyzing an event like this, you have to see what is it that works for my program, for my level of diversification, for my leverage, etc. And it was it was a good data point for us. So very, very happy to have had that.
One question I think is interesting to look at when you look at the dispersion of the results this year is the balance actually that you find between drawdown protection in March and then capturing the upside in the quieter months between April and August, because it's tricky. You cannot be. It's very difficult, or I don't know if it's even possible to capture both the upside of both periods.
One thing that was interesting here was the value of diversification, that actually the market's moving both in a way that was difficult to handle for many, were different markets than the ones moving in the third quarter and on the recovery side. So there was when we're talking about losing money, reducing risk, and then building risk back on, it doesn't have to be the same market. So it's that's just one thing here to keep in mind. And for us, the profile in terms of sectors that were winning and losing were quite different, in the early part of the year versus the later part of the year.
Oh yeah, but diversification helped in that. This recovery that started from the 23rd of March onwards, there's two drivers. In the Western world, it's mainly the support by central banks and governments that gave money to make markets recover. The other thing is that in many of the Asian Pacific countries, the crisis was pretty quickly under control, meaning economic recovery started there, and that were other trends. So the way, let's say, iron ore futures and so on recovered from April onward is huge, and that's helpful to have these different markets in there.
I think another important point is, we talked a lot about market risk, we talked about liquidity risk, but there's also operational risk. And in a period where, I would say, for most firms, the majority of the employees actually works from home, especially, kind of like back office and operations, etc. Operational risk can be higher because you just miss the kind of the random office chatter over the desk. Oh, we're doing this release and that. So we did pay quite a lot of attention to this because we were concerned, that something could basically slip through. So we introduced extra meetings, online meetings, etc., to discuss the exact procedures. And overall we were pretty pleased. If you look at the error rates we had, it was the same really historically. And we released more on the research side. Research remained really active. And again, any kind of research release, that is quite tricky in terms of operational risk, if so many people work from home.
And what would you believe is the main role of a CTA? Is it portfolio diversification? Is it tail hedge? Is it a performance engine? Is it crisis alpha?
I think ultimately what all investors will want is return. And typically for CTAs, return not linear correlated with long stocks and long bonds. So is that diversifying? Yes, it is. If it wouldn't be diversifying, then they wouldn't invest in it. Tail risk is something you replace one tail by another tail and have different tails is maybe healthy. Then you're a dragon. But it's the most important thing is that it's non-correlated. So that's one of the important things. Another thing, and that's just in recent times becoming more important, is that CTAs are actively participating in change. And if you look at this in a responsible investing and changing world situation, let's say if you compare it to a passive strategy, and passive strategies, the only thing passive investors can do is exclude certain areas which they don't want to answer difficult questions about. That's not real participation. to participate in change is very important in all kinds of changes. And what is a trend? A trend is something changing. A trend is, in the past, no one used Apple, and now everyone is using iPhones. That caused a trend in Apple. In the past, people drove with diesel cars, and now they changed to electric cars. That's a trend, and that has an impact on many different markets. To trade those markets and to bear the risks involved with such markets is an element to profit from change, but also a way of participating.
The key story, I think, for CTAs in my book is, well, we have a good correlation profile versus other asset classes, and it comes really from what Harold was saying here, namely that we are participating in change. We might be successfully doing so sometimes and less successfully other times, but essentially the idea in macro and CTA space is to identify something that is changing and participating in that. So this year, the slowdown in the world economy in the first quarter, and then the recovery perhaps in the rest of the year. And next year there will be something else. Now, the interesting thing here is, of course, that change is very difficult for traditional assets. This year, if I'm talking from Stockholm, change was difficult for stocks, and it was amazing for housing. Right? Housing was the go-to stimulus point. So, apartment prices and house prices are reaching records. Now, difficult for one sector, easier for another, but opportunities in this change. And if you are traditional investors, all of these changes, if it's slower economy or the recovery, they come with risks. So having something in your portfolio that has a decent chance of making money in these periods, that's quite helpful. And so this correlation, it's not because I'm sitting in my office and try to devise a correlation. It's something that comes out naturally from the fact that we try to capture change. And I think this is true for all here around the table or the virtual table. We are trying to capitalize on change, and that is the driver for the low correlation. It's not a statistician who creates something, or it's not a bought option profile created by replicating an option. That's not what we're doing. So that's, and I think that a third part perhaps is that since we are trading assets with few traditional investors do trade, commodities in particular, and less liquid commodities as well, there is a built-in low correlation with traditional asset classes on top of this participating in change.
Yeah, so to put it short, for CTAs, change offers opportunities, and for passive investments, change offers risks.
The opportunity maybe of the change is also the one that is sometimes difficult to explain to our investors, because some of the most profitable trend positions appear to be those who, when you initially start building up those positions, you have few believers in those positions. I think that's the definition of trend, is that you are going ultimately against the mainstream view about these changes. Is that, are you really sure you want to build up into that topic right now? I mean, some of the most profitable trades, really, we have some anecdotes about that in the past, where obviously you are confronted with a lot of skepticism, but that's ultimately what it's all about. Maybe just as a compliment on the way we look at it, obviously correlation is an important aspect. We are not unhappy with positive correlation to equity if it's happening at the right time. So that's what we call smart diversification. What you ultimately want to achieve is negative correlation to equity markets in stress periods and positive correlation to equity markets in up periods. And this is where this trade-off needs to take place. If you take a tail risk fund, you're going to pay a premium for having negative correlation to equity markets all the time. That's the only way to appropriately guarantee that you're going to make a positive performance at the next crisis. You need to somehow ensure this negative correlation. What Quantica is trying to do is balance that off. So we are just saying, like, we are not ready to pay whatever price comes with this insurance premium and to provide you with some so-called prices alpha, which we don't think is really a great attribute to sell, because you cannot guarantee that.
Definitely investors want returns, but investors want also diversification. And I think, at least like in the CTA space, there is a trade-off between that, because the most diversifying strategy is really trend following. Any kind of like other type of like, say, carry type strategy, they're not as diversifying to like, a long only portfolio. And there is a trade-off, because like, the fast speeds, typically they protect you better. They're more diversifying like the slower type speeds. However, they have not performed that well, with the exception of like this year. So there's surely trade-off, as Systematic has tried to kind of keep a balance between those, because surely you want to diversify the investor's portfolio. So you want to keep the overall trend following strategy reasonably reactive to make sure you can actually have a defensive role in the portfolio. The way we tried to kind of make up for like the returns is by like adding more markets. So we have been very active like in the alternative market space. One of our offerings is in there. We just launched like a China markets fund, which is providing access to around 50 markets in onshore China. So that's the way we try to kind of make up for the return differential, plus also just doing more research on trends. So we have not given up on trends simply because it hasn't worked that well, say over the post 2009 period on the traditional market set, but like add more markets, but then also simply try to innovate on trend by trying to exploit different types of trends. Don't just exploit like single asset trades, single asset trends, but look at like factor dynamics. Use like different types of statistical techniques to detect trends.
Where do we see innovation opportunities in the CTA space? Alternative markets is of course one area. We've had artificial intelligence, machine learning, I guess by now is an old school thing.
We are using machine learning, of course, at Volt, and I was kind of hoping that we were still the next generation and not just old school. But apparently, time has kind of sped ahead of us. But I think that when it comes to next generation, I mean, clearly there are a lot of things to do in trading more markets, and I think sourcing new information. For us, being relatively small, we have a hard time expanding into less liquid markets, mostly for the data reasons. That sourcing good fundamental data for less liquid markets is difficult because there is less of it. But one step at a time. But I think that the thing I hope to see in innovation is actually perhaps innovate away from passive ideas that you can create an index product that captures a factor of some sort and then just leave it to trade, and instead go back to basics and say, well, what really matters here is that there's a team in place. They know what they're doing. They are experienced. They've seen a selection of crisis events, and they have seen a selection of liquidity events, and they know how to make the trading program move forward. So that's what I hope is the step forward.
There is in all these innovations, whether it's alternative markets or other techniques, there is the huge risk there that it's more marketing than that's really something different. So in many cases, why is a market alternative? Because it's a small market, because it's the contract specifications are somewhat non-standard. The liquidity pool is somewhat non-standard. It's a few of those things. There are some alternative markets, and yes, it is different. You just mentioned Chinese markets. You could also say, well, there's nothing alternative about that. It's just another country. So having diversification is good, but whether to distinguish between standard market and alternative markets is something what is somewhat arbitrary and is more marketing than really something different, I would say.
The impact of innovation is a bit a function of your investment horizon. So the longer your investment horizon, the more constrained you are in terms of opportunity set. So typically when you run a medium to long-term trend following strategy, you can apply the most innovative techniques, add data sets and so on and so forth. There is only so much you will be able to extract with that longer term investment horizon. What is certainly going to increase the more innovative elements you put into your strategy is the complexity, and then the question is whether innovation is actually beneficial. So ultimately it's marketing, obviously, and we're in an industry where there is kind of a pressure to deliver some new concept. but you always need to take into account the complexity aspect. And we are very reluctant to modify the investment process because innovation usually comes with additional complexity. And the ultimate challenge is to innovate, but keeping the complexity low. So what we found as we went on with that process is that the opportunity set in the alternative market space just seems to be bigger. So first of all, the trend following signals are just stronger on those markets. And you can rationalize that by several ways. The access is just harder. It's more difficult to do than just trading a standard futures market. They're a bit more risky to trade. A Thai-baht interest rate swap is probably more risky to trade than a US Treasury notes futures, and where there's more risk, there's more alpha involved. But like a second aspect is just they're as a group, they're just more diversifying. And I agree with Harold that if you talk about, say, Chinese commodity markets, well, it's just like another market, well, it's an alternative market. You can call it anything you like, but in the end, it is harder to access, right? So you can trade iron ore in Singapore, but the onshore China market is 25 times more liquid. It's cheaper to trade, but you need to go all through the legal hurdles. And that's basically, I think, where the innovation is in. Can you actually do that? And can you reliably trade it? So there's this huge cost differences, which routes you actually go, whether you're basically willing to onboard some local brokers, etc. And there's an additional risk in that, but there's also additional returns.
Hedge Nordic, your single access point to the Nordic hedge fund industry.